Hey everybody, welcome. So we have a big announcement to make today. And we'll have to, Jack has had some technical difficulties and he's getting back on. Adam is on as well. And the announcement is in honor of Robert Mayetta's second anniversary in business with Survival CFO. And he works on some of our clients and he's been a great resource for some of these clients, but we are honoring him and we have decided to launch our own kind of side hustle. And what we are doing is we've joined the ranks of influencers and affiliate marketers. And so we are doing swag testing and we're promoting the swag of anybody that sends us swag that's a client or whatever, I guess. So anyway, legitimately big shout out to Robert Mayetta. Thank you for sending us appropriate and wonderful attire. It's actually really quite good. It's Callaway. So, and I wish I was a golfer, but I'm not, but I'll still wear Callaway. So anyway, we've got a lot of good things to talk about. We've got the Q&A that will be open and we'll keep fielding, let's spit it out here, fielding your questions through Q&A. You can harass us on the chat. And we do have a question that came in bright and early from Mike, and it's good. It's on ERC. So we're going to talk a little bit about that. We will actually tee up and probably do a much deeper dive on ERC next week because we've got some additional stuff, but we're going to focus this week on, pros and cons of stock versus asset purchase and some of those things that deal with that. Because we have had a lot of questions that have come in, not only to us, but also Jack, et cetera. So we'll do a little bit deeper dive on that. Oh, and Jack, you want to say something to the team?
Good morning. Sorry about technical difficulties when you drop your computer between place, home, and camera, et cetera. But anyway, glad to be part of the team, today. Wow, I feel special.
Adam.
Yeah, it's funny when I was gone, I went to Greece, and the way that the trip was planned was by following people on Instagram that had travel blogs. So I'd never watched one of those. So when I finally watched one, I saw this couple, and it's a nice young couple, and they're just traveling around Greece, and I'm like, people watch these people? And the response back was, yeah, and they get paid. It's like, what? Like, what do I need to do to be a social media influencer? Like, that's just crazy. So
yeah, we're trying.
So to Gary's point about the swag, again, congratulations, Robert. I do empathize. When we started BGW, we started in 2006. So that was a good way of starting a firm to then be baptized by fire, rolling right into a recession. So I totally empathize with starting a fractional CFO business right in the middle of a global pandemic. So there you go.
Yeah. So big shout out to you, Robert. Thanks for always being on these calls too. And between him and David and Joe, I mean, there are a number of folks that are pretty much regulars that we can count on good questions.
Yeah, and just as a shameless plug in general to the business that David and Robert are in, when companies start, this is so common. Hey, I need somebody to keep track of the books. Well, my sister, cousin, wife, retired father-in-law, I mean, you name it. Well, they'll take that over for me. Or I'm doing it myself. So, kind of that can serve a purpose up until about $2 million. I mean, it's advisable to have somebody pretty good in even below $2 million, but that serves a purpose up to about $2 million. And you really can't afford to hire somebody that's any decent in kind of a senior level accounting function until you hit, probably about 15 to $20 million in revenue. So, a lot of our clients sit in that gap between 2 million and, 20 million. And, I got to tell you, just from our perspective, there's a massive difference in what we're able to do when a company has a good accounting team and good information in terms of helping people make better decisions than when we're spending most of the time saying, well, that is not right. That's not right. That's not right. So it's just, for anybody that's on the call that, has been on the fence about hiring somebody, or, this is, hey, I wonder what those guys do. Let's investigate it more. Yeah, we would, even though it's more money, I think I can definitively say that we have been able to save or make way more than the cost of what the additional service costs. So highly recommend it.
Right on. If you guys are okay with this, let's jump right in to this question from Mike. So here's the deal. So again, Mike, thanks for sending this to us. Here's the question. He saw an article, came out over the weekend from CNBC. If anybody wants it, I can probably put it in the chat. But here's the deal. Relevant section from this article seems to imply that the 2020 ERC retroactive credits, you would get the funds faster by filling a form 7200 than 941X. For an employer who already paid 2020 taxes, the ERC can reduce their overall liability and the cash claimed retroactively. To get the ERC money back in the form of a refund on taxes already paid, the business must fill out an advance payment form or Form 7200 with the Department of Treasury's IRS or Internal Revenue System. So a lot of these businesses have short cash flow runways, and it's really important to get as much money now rather than be reimbursed later, according to a person in that article. So thoughts from Adam and or Jack?
Yeah, so I apologize that I had not read the article, Mike. So unless the guidance had been updated or the instructions had been updated on that particular form, so I'm going to talk for a while, Jack, so you have the chance to, do your thing and Google the answer. Unless the instructions had been updated, the article is correct that applying for the advance payment of the credit is the fastest way to get the credit back. The problem is that only applies to the instructions as they read as of, a couple of weeks ago, that only applied to the quarter that you're in. So the problem is that if you're applying for 2020 credits, which, most of our clients would not have qualified for the 2020 credit at the time in 2020, that form was out and you were stuck with emitting a payroll tax return. So if Jack has a chance to fact check me, that's great. Otherwise, I promise that we'll send an update if what I just said is not true. So I don't think the form was available unless they updated the instructions for a prior year credit. So all of that said, in terms of, expediting the funds, the other avenue that I would pursue for people that are in this bucket for the 2020 credits, since most of our clients outsource their payroll to a third-party provider, we know that Paychex for sure, which means that probably ADP would follow suit. So likely only a small payroll company would not do this. They've started doing lending programs in advance of the credit because they're taking your money anyway. So what you ended up doing in those scenarios, from our understanding, is that, let's say that you were due to receive, 500 grand in a credit, and it's going to take forever for it to play out in terms of remittance of your payroll taxes. In other words, getting a credit against future payroll taxes that you got to pay. What ADP or Paychex would do is they would give you the 500 grand, then you would still submit your full payroll. but they would only be required to then remit to the IRS less the credit that you would have gotten on their payroll tax return. So, that is another, assuming that I'm right on the procedure for getting the 2020 credit. If you're with a larger payroll company, I would also advise going that route if you're looking to get the money back in a more expedited fashion. And that's something that's relatively new that Gary and I found out about last week. And it still took some more digging on the part of the Paychex rep. And as I said, we haven't talked to ADP about it, but our assumption would be that if once one big payroll company does it, they all, kind of pile on and start following suit.
Yeah, I'm pretty sure because we first heard about it from Paychex, and then I had another conversation with a former fairly high-ranking person at ADP, and they indicated the same sort of thing, and I don't remember what they called it, but and that makes sense because ADP is one of the, both of those groups are behemoths.
And we've done that, frankly, we've done something similar for clients. I mean, if a client knew that they were going to get a refund and didn't have the money to pay us for the services, we've had the refund delivered to our office. Hopefully that's not illegal, Jack. And that's just kind of, there's a refund, there's a check for the services. All right, now we're square. So it's not, this arrangement isn't unusual.
Well, I quickly scanned through the article, and a little more time to make sure that what you said sounds correct, but I would rather punt a little bit and just make sure that we give the right answer to Mike.
Well, that's the lawyer in you speaking, which is good. That's why you're on here. So.
Yeah, our commitment is that we'll do some type of post about it, probably over the weekend, with either we were right and here's the answer, or hey, we didn't quite get it right, here's the other answer. We'll do a post that we blast out over the weekend.
Yeah, like I said, I think next week we will have more information and some more answers on ERC. So we'll probably dedicate a fair amount of next week's Throwdown Thursday, or whatever we're calling this. I kind of like that one, Throwdown Thursday. It's not quite click and clack, but in car talk. But anyway, so Jack, I know that you are, with your role as an M&A guy, you are getting a lot of these same questions about, hey, what are the pros and cons of asset purchase versus stock purchase and sale, et cetera, if you're on the other side of the table. You want to talk a little bit about what you're hearing and go into some of the advice that opinions, Jack theory. So it's not advice.
Observations yeah. Is probably a good word, right? Yeah, absolutely. So it's the M&A market has been increasing significantly, and not just large buys and mergers and acquisitions, but those who have basically punted through COVID that maybe were already on track for the part of their exit plan that got delayed for whatever reason. A lot of it being that their business just isn't valued as much as it was prior to COVID, and and because if you're looking at a business that is service or product oriented and they're not providing services, not providing products, how it isn't indicative of the actual value of the company, because they are basically paralyzed from doing their core business. And so, we're seeing increased activity. And always the first question, I shouldn't say always, that's too definitive, many times. The first question is, what form should I do? And the seller saying, well, I want a stock purchase, and I've been told that I should do an asset purchase because I just want the good stuff. I don't want to take any of the bad stuff. So as a default, from a legal perspective, an asset purchase is usually better than a stock purchase. And I'll punt to Gary and Adam to discuss the tax issues in relation to both and why you might choose a stock purchase over an asset purchase, either from the seller or the buyer's perspective. But so my discussion is from a legal perspective. And so the reason why the asset purchase is the better way to go is because just what I said a moment ago, which is you, in theory, get the good stuff, the assets, free and clear from liens and debts and other obligations of the seller, and you let them keep the bad stuff, their liabilities, etc. Other than the liability, and these are very broad general statements, by the way, other than the liabilities that you assume. So those are assumed liabilities. And those may be things like if you sell a product and there is a warranty related to that. So you are assuming the obligations under the warranty, providing the service of the warranty on that product. Or there may be obligations that are contractual obligations, material contracts, suppliers, vendors, whatever it may be, customers, that you are accepting those liabilities moving forward. You're also accepting a lot of times, obviously the revenue stream as a potential asset. So and I don't want to go too deep into kind of the mechanics of it, but in both cases, well, let's compare it to a stock purchase. So with a stock purchase, you're getting everything. You essentially become the owner of the company. And yes, in the agreement, there are obligations for the seller in both cases, asset purchase or stock purchase, to tell you all of the bad things that you want to know about if they exist. So it's actually the reverse. You have a section in either an asset purchase or stock purchase agreement that says, I, the seller, and the shareholders hereby declare that I have no tax liabilities. I have no issues with employees. I have all my stuff is properly organized. I've paid all my taxes. All these things. I haven't had any data breaches. I would say in the past 5 years or so, I've added that as a representation and warranty, just so we know that there hasn't been any data breaches or any technological issues in relation to the company. So you get all these things, and then at the back of the agreement, you get to put all the exceptions. So you'll see, except as on schedule 3.24A, we had an audit. The audit came out great, but we had an audit. You have to report those kind of things. And so that's the way the mechanics work on both. With a stock purchase, again, for me, it's more of a financial issue from a buyer's perspective, potentially from a seller's, from a buyer's perspective, as to whether or not they would proceed with a stock purchase, and it has to do with basis and taxes and things like that. But the core is the asset purchase agreement, and you move forward with that and you get the stuff in there. So the components of the asset purchase agreement are, this is the transaction. These are the representations and warranties that the seller is making to the buyer. And this is your insurance policy obligation, your obligations if there was a misstatement or a lie. And then how do you fund that? And that's where you get into holdbacks and escrows and releases of money over the course of time. So you have the transaction, the obligations for truthfulness or stating what the status quo is. You have an obligation to pony up if there is a problem. So let's say that there was an employee issue that the seller didn't disclose, and it caused you as the buyer to have certain, because they're your employee now, and the Employment Commission, or let's say the IRS, really doesn't care necessarily. They follow the assets a lot of times. You have a contractual obligation or a contractual right to go back against the seller. Well, that's great. I have a piece of paper that says I can go back against the seller, but what if the seller has taken your millions of dollars that you just paid them and gone off to Belize or wherever? And so what you do is you have a holdback, a percentage of what the purchase price is, and you put it in escrow, and then that becomes your insurance policy necessarily. So, I mean, that's kind of a quick overview. Stock purchases are kind of the same as well. And then there's just different components that go into that. I know that you guys, and because I briefly looked through the video from last week, talked about working capital And, maybe we can talk a little bit more about that, how that plays into a stock purchase in particular, where, you want as when you become the new owner of the company and you're buying an existing company, the entire egg, then on day one of your ownership as the new owner, you want to be able to run the business. You have to have sufficient cash in the bank to be able to do that. And so you're paying for it as a buyer, but is there sufficient cash in the bank to do that? And then you have trade-offs. If there's not enough working capital, then someone has to put money in. If there's excess working capital, then a lot of times the seller gets the benefit of a payout of that because you've marked it at a certain place. Let's say it's $1 million. And so there has to be $1 million in the bank of working capital at the time of closing. And then usually it takes, 30 days or so to make sure that that was actually the case, and then there's payouts. So I feel like I'm going a little bit too deep into, and I'll stop there. So that way, if you guys want to jump in kind of like on the 30,000 foot level on either side of asset or stock purchases.
Sure. Let's take her back up to 50,000 feet, Captain. Get out of the turbulence. I'm just kidding. I would echo Jack's comments. If you look at, BGW world, I'd say, without looking at a lot of data, I would say that 95% of the transactions within our client base, either buying ours or selling, are asset-based purchases. Jack talked about the legal side a bit. On the tax side, the reason for that is real simple. As a buyer, if I buy a company, if I do an asset-based sale, assuming that I bought receivables, I don't have to pay taxes on them when I collect them. Assuming that I bought fixed assets, I get to redepreciate them. So I'm getting, even in the plug, like let's assume that I'm paying a price that's in excess of the book equity of the company. The plug, which is the goodwill, blue sky customer list, blah, 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 even that's a tax deduction that's considered what's called a Section 197 intangible, that's deductible over 15 years. So when I buy a company through an asset sale, I'm getting ordinary income tax deductions over the, while I own the company, and presumably while I'm paying, debt on the acquisition itself. Well, what happens when I, as the buyer, go to sell it, when it's my turn to sell? Well, I have to pay capital gains because I've got, relatively low basis in the company because I redepreciated all the assets, redepreciated all the goodwill that I bought, all that kind of stuff. But remember, there's, as it stands today, a good, 10 to 15% difference between the ordinary income tax rate and the capital gains tax rate. So what I'm basically doing is I'm saying I want an ordinary deduction now at a higher tax rate, so it's more cash benefit to me, in exchange for I'll pay more in capital gains taxes in the future, but that's going to be at a lower rate. So the real savings to the buyer is kind of that 10 to 15%, along with the time value money and all that other kind of stuff. If capital gains rates and ordinary rates were exactly the same, it wouldn't matter. You would, the taxes would end up being the same, and you would only be debating, am I getting a deduction this year? Am I going to get a deduction when I go sell the company through having a lower gain potentially in the future, which is probably, I said I'd go 50,000 feet. I probably took it down to like ground level on that one. So, kind of going back to the 95% thing, asset sales. Here's the real gotcha. I haven't checked the participant list to see who all is on the call today to see if anybody would be impacted by this. But in every single case, when a letter of intent is sent over to me, hey Adam, I'm so excited, I got this letter of intent. It's great. First off, congratulations from us as an order, because hey, this is why you work so hard, is to have a liquidity event. And the first question out of my mouth typically is, do they talk about the form of the transaction? Is an asset-based sale or a stock sale? Invariably, the answer most often is one of two things. A, the letter of intent is silent, which is then followed up by, yeah, but over drinks, they said they're going to buy my company. So that, of course, means stock. Or B, it actually says stock. So when it says stock, the silent killer is what's called a 338H10 election, which is a stock sale, but for tax purposes, we're going to treat it as if it was an asset purchase, asset sale. So all that same tax stuff still applies. So you think you got a stock sale, but not really. Just kidding. You really have an asset-based sale. Why do buyers want to do that? Well, there's some cases like if you had, if you're so take a medical provider as an example, your EIN is registered to receive, Medicare payments. Like that EIN specifically has value associated with it, and you want continuity of that. Well, I would want to buy your stock, but I'd want the benefit of all the tax deductions that I talk about. Therefore, I'm going to ask you to do a 338H10 election. And when am I going to do that? Probably about the same time that I've ground you down on every single other freaking term that's in this agreement. I'm going to hit you with two things that are totally going to screw you: working capital target, 338H10 election. So I always count, I'm not always listened to, even though I am the smartest person that people know. I'm just kidding with that, by the way. I always counsel people, look, they're not going to want to bring it up, or they're going to push you off and say, we'll deal with that later. Hit them right up front with working capital. And what are we doing? Stock deal or asset deal? And ask specifically, are you intending to do a 338H10 election or not? Because the answer to both those questions impact your net proceeds. And you only agreed to the deal in the first place based on an assumption of what your net proceeds are. If I hit you at the 11th hour when you're freaking tired, you'd sign anything, including your firstborn, over to me just to be done, and then I effectively extract another 10% out of you. Okay. Yeah. So you're way better off just getting that out up front.
You both bring up really good points. And the one thing that I would say is, and I want to go a little deeper into the letter of intent and what's lurking beneath the surface on that, because as Jack has gotten back from his scuba diving vacation, where his wife was not so thrilled about that idea, thinking about sharks and whatever else may be lurking beneath the surface, but there's always stuff in that letter of intent. And before you sign anything, make sure you have smart legal counsel that actually has experience in M&A versus, hey, they're a jack of all trades and master of none. I mean, there are specialists for a reason, but also make sure that your CPA knows what they're talking about, and they're part of the consultation too, because those two things have dramatic impact. And once you sign it, you've signed it, right?
Yep.
Yeah, and if we want to go kind of into that, since it was brought up, a misconception, a common misconception or mistake, actually, if it's signed, is not having your accounting and legal professionals look at the LOI. And we understand why. It's because, oh, well, an LOI, it says right here, it's non, okay? And so why would I care? It's just basically, no different than sending an email with bullet points. Well, mostly yes, but here's the thing, the letter of intent, memorandum of understanding, memorandum of intent, there's various names, LOIs, right? So with the intent of those LOIs is to make sure that the parties are in the same ballpark, in the same universe, as far as material terms of the contract, which include obviously purchase price, terms of payment, and as Adam said, a lot of times what is missed is, okay, stock or asset purchase, And then specifically, is there going to be a 338 election, and working capital, especially in a stock deal? It's like, well, wait a minute, no, I'm sucking out. So in the seller's mind, even though it's a stock sale, it's, well, any cash that's in there, I'm pulling out because the buyer's coming in with their own working capital. They're bringing in their own money, they're bringing in their own working capital. So yeah, that's my cash. Well, when you're buying a business, you can't run the business on day one of your ownership without having cash in the bank to run the business. And so people come to us with signed LOIs, or, hey, I just, we negotiated this and we're on the verge of signing tomorrow. Can you review this? And so my first questions are, okay, those which we just shared, but also, have you talked to your CPA? And because they are the ones who understand that whether or not this is a good thing for you to have an asset or a stock sale, they understand the basis in what you have and the assets that you have. They understand the consequences of going left or right in that fork in the road, because you are at a fork in the road at that point. There are certain items which are enforceable and which are binding. So if you have if I'm representing the buyer, I want to have their exclusivity, a no shop provision in that LOI that says, hey, I'm going to spend time and effort looking at your business in anticipation of buying it. So I really don't want you to be out shopping it around and talking to other people. And if that happens, you need to let us know that has happened, because we want to know, and we're kind of curious as to what market is and see what else is out there. We don't tell them that, but that's also a reason for doing that. Confidentiality. If you don't already have an NDA, a non-disclosure agreement in place, then this is a good place to put it. I suggest you do it way before you even, because you're not going to get an LOI unless they know something about the business, which means you've probably disclosed some financials to them, which means you should have had an NDA. But the letter intent should have a paragraph that says, or a sentence that says, and the obligations that you signed up for last month continue on in this relationship. There's also an obligation to the definitive agreement, the definitive document, which would be the asset purchase agreement, the stock purchase agreement, that will be signed. Expectations as to, does the seller, is there going to be an employment afterwards? Is there a consulting arrangement? Expectations, a lot of sellers are very protective of their family. There's a bit of trepidation as to, I don't want to sell this, but as long as I know that my family is okay after the closing, that you're going to offer them jobs. Well, what are the expectations? What is the buyer willing to do with respect to that? And I would never let a buyer in an LOI or even in an asset purchase agreement that's signed before closing. So it's a sign, and then 3-month closing down the road after you've done your due diligence. I would never let them commit to hiring anyone. You have to go through and find out, are they a good person? Do they have a good driving record? Are they a good worker? All those things. So, but the commitment to, if everything lines up properly, then yes, we will continue this person as the manager. We will continue this person as your finance person, those kind of things. So it's really, and what it does is it helps save, it's not going to answer every question. That's what the definitive agreement is for necessarily. But it helps make sure that there isn't just some disjointing between what the expectations are. So it's an expectation management tool that I think that is an appreciation for its value in having it properly documented and not treating it similarly to having writings on a napkin or a bullet point list and that kind of thing is really important. In some instances, I know of at least one instance where it says, you must proceed in good faith. So you can't just say, I'm out. And, enforcing that can be a challenge, but in one jurisdiction, I think it was in Colorado, there was a case that said that if you, even with a letter intent, and you have that good faith and fair dealing language in there, and you decide that you just don't like it, like the buyer, we were able to recover, and I'm saying this is the exception, like the minuscule percentage, that we were able to recover costs on behalf of our buyer client from the seller because of that language. So in the hopes of that happening elsewhere, we always put that in there, but a lot of times that is missed because it's like, yeah, okay, of course we're gonna, in good faith and fair dealing, why else would we be getting into this deal? So anyway, I just wanted to share those things with respect to letters of intent, because I think they are not utilized to their fullest potential. I think they're somewhat abused, in meaning that it's just another piece of the puzzle that we need to go through. A lot of times the LOI is skipped, and it's okay, hey, we've been working on this asset purchase agreement that was provided from somewhere. In a franchise context, it's like, okay, well, the franchisor provided this to the parties and we'd like to use this. Well, you haven't figured out whether you're in the same ballpark, in the same world. And so you get kind of deep into it, and then you realize that this isn't going to happen. And you've already spent a lot of money on professionals and other things moving the ball forward in anticipation of a closing, where if you had this mechanism of making sure that the material terms were in the same arena, then you would have avoided the expense or come to a resolution of that issue much earlier on than in the middle of drafting an asset purchase agreement and in the middle of due diligence, where you have one of our associates thumbing through that virtual data room to look at material contracts and everything else. So I can't emphasize enough how important the letter intent really is in an asset sale or a stock sale.
So you went where I was going to go, which was, give me an example of an extreme real case that happened where there was a gotcha in the LOI. So Jack, you kind of did that. I don't know if you have another one that you want to talk about, but Adam, I know you've seen a lot of these as well. We've had a lot of clients that have either purchased or been purchased. Any war stories where you go, gosh, duly noted, make sure that we tell others not to go into the same place.
It really does come down to the two issues that I highlighted, working capital and tax treatment. And I've had war stories that have been on the same transaction, and then sometimes where it's one issue or the other. But if you think about working capital specifically, we hit this a little bit on the last week's webinar. If I've been running the business, and I've got $1 million sitting in my checking account, and it really only needs $100,000 to really operate it in cash, because my receivables are always good, I bill timely, I collect timely, all that kind of stuff. So I need minimal cash to really run the business. The buyer doesn't know that. All they're going to look at is historic data, and they're going to say, no, it really requires $1 million cash. Prove to me otherwise. So that has been a gotcha that has bitten me. Well, bitten our client, hadn't bitten me because it's not my money, but has bitten our clients over and over again. And then on the tax treatment, same thing. It's, hey, we got almost to the finish line, and then next thing you know, the seller is effectively putting 10% less money in their pocket than they thought, due to a last minute insertion of, either the 338H10 election, if it was an S corp sell, or even when it's an asset sell, doesn't freaking matter till you see the asset allocation schedule to know what you're really going to get. And if the buyer's trying to jam a massive amount on a covenant not to compete, a consulting agreement, and your fixed assets, you're screwed. That's all ordinary income. It's not capital gain treatment. So it just, those things are the things that always, if we're going to have a problem from an accounting and a tax standpoint, it's those two issues. Jack always deals with everything else. I'm like, oh God, whenever I said that I wanted to play a lawyer, not really. Like I watched My Cousin Vinny the other night. I don't know why, but it was on. So it's like, I want to be Vinny, but then when I'm done being Vinny, I want to be done.
Yeah.
That's about it.
Well, I'm gonna take all the Utes on this call down a little bit of altitude on the working capital issue, because this has come up, and it's you get to, a lot of times, like with an S corporation, you have all this money and it's sitting there. There's not a retained earnings account, so it's just sitting there. And from the owner's perspective, the seller's perspective, that's my money, that's his money. Okay, and it's sitting there, and you're looking at this, and like, okay, is that really working capital that needs to be in the bank? To your point, the 100,000 versus the $1 million. And so, understanding what the true working capital number is, meaning the amount that's needed to operate the business from that perspective, and then understanding when you're building what the working capital expectation is at the point of closing, understanding and having samples and pro formas at the time of drafting the asset purchase agreement, so it's very clear as to what the formula is, what is in and what is out, because there are discussions and arguments as to what should be in that calculation. For example, money that is a deposit that is showing that has been received, but yet there's an obligation to perform down the road. And it's like, well, wait a minute, there's money, but there's the obligation to perform may not be showing up. So there's an incongruity that really the working capital number isn't quite right. So you go through these adjustments and you set the formula. So that way at closing and beyond, you're not arguing about what should be in or out. You're simply plugging numbers into a formula. So, and I say that simply, there's nothing simple about it when you're talking about who owes money post-closing based on working capital calculations. So, and also important is to have the referee, the arbiter in place as to, okay, the process is, simply stated, is that, the buyer comes through, most cases, the buyer says, okay, we've done our calculations. This is what the working capital number was. Here was the target that was already established. Here's the working capital number, and here's our audit on it. And here's the meaning of that, meaning who owes money to who, or were we spot on with the number? And then the seller gets to look at it and respond. And then there's a disagreement. Well, who's going to deal with that? And a lot of times you appoint a CPA firm or someone else that is not involved in the transaction, so a true third party, to be the referee to decide and ultimately say, okay, yes, this is the number. So buyer, you owe seller some money, or seller, you owe buyer some money to get it up to the level that's supposed to be. So working capital logistics can be challenging. So my suggestion is have the formula set early on, so you're not arguing about it down the road, and have an arbiter in place, and usually put it in the asset purchase agreement, stock purchase agreement, as to financial issues that are at issue, who gets to decide the financial impact of those things. That is not related to either the buyer or the seller.
Man, you guys brought up some really good points on that, because unfortunately, I've seen it where one group and their legal counsel has to prove that they've got more firepower than the other guy's legal counsel. And then it becomes, we're paying for your bravado and going back and forth, right? And so, I mean, you bring up a legitimate point, which is, can we have a referee that's, somewhat neutral, but also nailing the framework of what's in and what's out early? It removes a lot of that ambiguity, where it allows for the jockeying. Now, I know you wouldn't do that, Jack, hey, let's see how long we can make this battle last, because it increases our fees. But I have seen that happen, and it sure felt like that on the other side. So anyway.
Can I brag on Adam for a moment? So that exact situation happened with respect to negotiations back and forth. And so, and interestingly, the CPA on the other side is a friend of mine from Chapel Hill. And so I kind of felt bad that we had to have this conversation, but we had to have this conversation. But I'm glad that Adam was the one that was having, being the adamant person in the conversation. But it came down, and very difficult legal counsel on the other side, older gentleman who thought that he knew and knows everything about M&A transactions, and Adam was coming up with multiple solutions to resolve the issue at hand. And they were being adamant about it was about a small possibility of something happening down the road based on the way we were going to do some tax treatment or something. And so Adam basically says to the other side, to the attorney, it's like, look, if you are being an ass, he didn't say it this way, but the message was, if you are being a jackass just to be a jackass, to basically bow up, and then you go tell your client that you're being a jackass, because we will tell our client you're being a jackass, and and that you personally are stopping this transaction, or tell us why the 3 paths to resolution are not going to work for your client. Make sure your client knows what the 3 are, and then let us know why your client is not accepting any of them, because it was the attorney that was the bottleneck. And so, but I mean, I was just like, I literally, if you could see me in my office that day, because I was standing, I was pacing with a headset, and I'm like, I'm like, yeah, like, okay. And it wasn't, but it was done at the appropriate time, because it was, you build up to, okay, here's reasonable solutions, and the CPA on the other side was quiet, and then after the fact, I had met with him socially, and I said, so what was going on with that? He's like, well, it wasn't me, right? I'm like, yeah, I know. He's like, yeah, I wanted to agree with you, but I couldn't. I'm like, I know. Okay, so those things happen, and so but those are things that are out of your control. So we're suggesting that you do as much as you can to control the variation and the interpretations as to at the appropriate time, the letter of intent phase, the NDA phase. Okay, that we kind of skipped over that, but going back to the very beginning, as a seller, you're basically going to expose a lot of things. Okay, and so how do you do that? So we use a virtual data room, so we know who, when, what time, down to the millisecond. Who did what? Did they download it? Did they print it? Did they do those things? So that way, down the road, they say, we were like, there's no way they could have known that unless they were exposed, but for their exposure to this information. Well, who was exposed to it? Oh, well, it was the COO of that company that downloaded it on July 15th. So it's those kind of things. Again, we don't have the answers for everything, but there's certain things that are just kind of have become the norm that you can protect yourself on both the buyer and the seller side. And from the buyer's perspective, it's like, okay, that's great, because if you don't have a smoking gun, the only way we would have known that information is because of our exposure to this potentially. So it wasn't us, that brought this out into the open, whatever it may be. So anyway, just wanted to brag on Adam, because it was appropriately, professionally done with respect to the amplification of letting this guy know he was being an ass and being obstructive.
Rock on.
I remember that, and I remember where I was standing, and I remember I was pacing too, and I remember being very pissed off. So, thank you, Jack.
Well, I love it. If we're not passionate about our clients, then we're probably in the wrong business, or we have the wrong clients. I don't know, but I love it. So here's a little bit of trivia that I'm going to throw out, and the right answer will get a Starbucks card from Jack. So who can name the company, since we're talking about, affiliate marketing and that kind of stuff, doing the survival CFO thing, what brand had these ads running for a long time? And this will date us a little bit if you know, but you can pay me now or you can pay me later. Because if you pay, you're going to pay it later in a transaction, if you try to skip any of these steps and you want to go, oh, well, I don't really want to engage my attorney because this is going to cost me some money, or, hey, I'm going to have to engage my CPA because this is going to cost me some money. You can pay us now a little bit, or you can pay a lot later for making mistakes. So just think about that. So question from Christina. This is actually a really good question. Do you recommend placing key person insurance during a sale if this is not already in place to ensure a buyer is surrounded by experienced staff and owner post-sale? Could be a gotcha for the buyer.
So I think underlying that are two components, key person insurance versus just having your key people locked in. So with key people insurance in the classic sense, that's, hey, if Gary dies and Gary's an amazing salesperson, then I've got the money to replace Gary. That's always a good idea, regardless of whether you're selling or not, based on, a lot of that's based on, look, if Gary's a, 5-time cancer survivor, he's probably uninsurable. So insurance may be cost prohibitive at that point. But, as you see Gary, he's fit as a fiddle. He just can't wake surf.
Yeah, exactly.
So I probably could afford insurance on him, assuming that he would be willing to let me insure his imminent death. Absent that, though, in terms of lock and key people in, yeah, I mean, that's like, if you look at kind of value drivers, is that kind of in your top 10 value drivers? Yeah, it absolutely is. I mean, demonstrating that the company is not dependent upon you and you've got a good team in place and that team's not going to bolt the second there's a transaction, that is in the top 10 drivers of value associated with what someone's willing to pay for your company. So I hope that answered the question. Now,
right,
what Jack would, I would ask this question of Jack, so again, going back to, hey, it's always a good time to do stuff like that, where you're in a, wow, that's kind of poor form, is when you slap the non-compete agreement and lock the people in strategy in place like 1 month before a transaction set to close. That's, don't expect anybody to rush and sign that without extracting a price from you.
Yeah, employee relations are tough. And for example, as you guys know, the three of us and our respective companies were working on a transaction that came down to the seller did not want to give our buyer access to key employees until it got closer to the end of and have some escrow funds go non-refundable to get access to those employees. So and again, we came up with reasonable solutions, and they said no. So we said thanks, but no thanks, and call us back if you're interested in being reasonable and selling your business. As far as placing insurance on others prior to, I mean, for me, it doesn't hurt to go ahead and start talking to insurance companies to make that happen. Obviously, you wouldn't have that insurance in place till after closing, till after they are an employee of yours. And so, and it may be that, that becomes a benefit to them as well, which is that, depending on the payout, you may say, okay, they are contingent beneficiaries, that if you were only going to pull, let's say it's a 200K policy and you only needed 100K for that first year to replace that person, that you might give the beneficiaries of the decedent's estate the rest of the 100. That gets into complicated tax issues and who's paying and who's going to pay that as income, as salary. So, but yeah, I mean, that kind of question or those kind of issues that Christina brought up are things you need to think about, the longevity and what happens the day of and day after closing. In this particular transaction I was telling you about, there was not concern, but just want to make sure that the ship can continue sailing the day of closing under new ownership. and that the people, the management teams at these various locations were loyal to their employment and not to their current employer. In other words, if he's out, I'm out kind of thing, because these are key employees and it's in a very competitive market. So we also wanted to find out what these people wanted and needed. And it may be the case that they were okay working for this guy for less than market because it's this guy. Maybe they feel loyalty to this person that gave them an opportunity to be in management when they really weren't qualified, but let them learn through experience and taught them as a mentor. So they feel a non-monetary loyalty to this. Now you have some outsider coming in. It's like, all right, now I'm going to get paid. Now, I don't have that same non-monetary loyalty to this buyer. So I want to get paid at market, or guess what? I'm going to go down the road and work for a competitor. So yes, those are things that you need to think about, which is the continuity and the continuation of the business as is. Even if you have ideas to make it better, make sure that you can at least take it there. And then you may have ideas in your mind as a buyer as to, oh, I know how I can make this better, but you should reach out to your new employees and really get the pulse of what's going on. You may think that they want more money, or that they'd be happy having a pizza party every Friday or something in the break room, but it may be that no, they really want parking partially subsidized in the parking garage, those kind of things. You just really don't know necessarily until you really get into the thick of it as to what's important for the continuity. So that's a long way of saying you need to know what you're getting into with respect to the people that you rely upon to run the business that you're buying. On the seller side, kind of the same thing. You need to know that, and you want to have some assurances, I would think, that your employees are going to be treated well and continued on moving forward. You can't, well, in some cases you can guarantee that by having employment agreements in place, and you don't sign as the seller until those employment agreements are in place that may have specific for-cause terms for that manager that's now going to become an employee of that new entity, of that buyer. But in most cases, the best that you can do is say, look, these are really good people, and you need to rely upon them, and you need to make sure you take care of them moving forward. So anyway, a few thoughts on that.
Great points. And Christina followed up and said it's really important to have a solid exit plan in place prior to the sale, the key person, golden handcuffs, whatever you want to call it. So the right thing to do for your people who do good work for you. So she said, great information to business owners. I'll bring others to the next session. Thank you. That sounds great. Hopefully we are providing benefit. But one thing that you can think about, and not every insurance agent is proficient in this, but there are insurance strategies that you can incent for key employees that will actually pay the employee for, meeting milestones in, whether it's a 5-year term or something like that, where they get a big payout. So it's not just insuring for your own safeguards, but it actually benefits them. And I think that's a really important thing, because people are not cattle. They are not poker chips. They have free will every day. And if you lose sight of that, you're going to get burned. So thank you, Christina, on that. And by the way, Jennifer, you nailed it. Fram Oil Filters had the slogan, pay me now or pay me later. So, the whole point was change your oil, change your filter. And that's a small price to pay versus changing out your engine because you failed to do that. And I actually saw that happen when I had a Toyota. It was in for service, and somebody had a new minivan in there. They had not changed the oil or filter, and it was like an $8,000 engine replacement because it was less than a year old. It's crazy. So anyway, I know we are about out of time. Let's see if we got any other questions. It looks like we've answered what we needed to answer here.
Can I share a few more things? I pulled up a letter of intent, recent letter of intent, and there's a few things that I just want to, that we didn't mention. We talked about conditions precedent, but we talked about non-compete. So this says, 5 years. So the timing of it, some people may say, well, I'm out for 3 only, and I might want to do something else. Some people, 5 years, 3 to 5 years is pretty typical in an asset purchase, not typical for a pure employment agreement restriction. A lease agreement, that's also important. It's like, okay, what are your expectations? Have in here that you're going to enter into either a new lease or assume the current lease, but along terms and conditions that are satisfactory to you as the buyer, because a lot of times landlords will use this as an opportunity to modify the rate structure, the rental lease payments that are due, at least maybe in the future, or modify the options. You may want to add options based if this lease is almost to its current end, even as extended. Financing, okay? If you, that's big. It's like, well, wait a minute, I thought, it doesn't matter. That's up to you, buyer. You have to get the money. I don't care really how you have to do it, but from the buyer's perspective, it's like, well, if I can't get an SBA loan, then I can't do this. So that should be clearly stated in here. Binding provisions, we've talked about, exclusivity, conduct of business. You usually put that in there to say, look, even though you're 1 foot in the retirement door, 1 foot on that sailboat, wherever you're going to do the day after closing, you still have to run your business normally. I don't want you to have inventory dwindle down. I don't want you to start hiring people with 3-year employment, your cousin with a 5-year employment contract, and start, doing these kind of things, or start spending kind of money. It has to be you maintain whatever your path was with respect to the business, and don't start going berserk on us with all kinds of expenditures or those kind of things. Or, as I said, dwindling down of assets. If it's a company that provides products, you maintain the inventory levels so that there's not a slowdown potentially. I mean, I've seen where in some cases, the inventory level wasn't where it was supposed to be, so it caused some issues for the buyer on the front end. I mean, imagine new owners can't get their act done, can't get their act together to do what they need to do as far as providing goods and services. So, and then governing law, that gets taken for granted. It's like, who cares? Their law or my law. You're the buyer, you have the money, it should be your law. And obviously I'm a North Carolina lawyer, so I'm going to want it to be North Carolina law. So those things to consider too. But again, just sharing some things that kind of white noise sometimes in these transactions and these LOIs, because, after all, they're non-binding. So who really cares, right? So, and that was sarcasm.
Hey, Jennifer, I sent this to everybody. If you would send me your email address, I'll forward it on to Jack, and BGW is happy to bequeath a Shoemaker Starbucks card.
Spending our money again. I wrote it down this time. You can't see it because of the thing, but it's on a sticky note. But yes, I do need your email address, and I'll ship that out to you electronically.
All right, cool. Well, this is a topic I think we're going to probably have to come back to, because we didn't even talk about, like, what are the implications of impending tax law changes that impact this? Like, what should we be asking for to make, square things back up, so there's some, we will have to go back into this conversation again, I think, because there's still a lot of money out on the sidelines right now. There's still a lot of activity, it seems like, that we're seeing. So anyway, hopefully this has been of benefit to everybody. If anybody came on here late, we will put it up on the BGW YouTube CPA YouTube channel later on today. So just look up and Google BGW CPA, or do it in the search of YouTube, and you'll find our stuff. And so this was our 69th week. Next week is our 70th week for Throwdown Thursday, or whatever we're going to call this thing. But Anyway, we appreciate it. Jack, it's good to have you back. We're glad that you're above the sea and not under the sea anymore. Same way with
Thank you,
Adam. It's good to have you back in the United States versus enjoying all of the Greek life and the Greek food. Any last thoughts or comments from y'all?
No, just be safe out there.
Yeah, right. I would reiterate that, if there are topics of interest or discussion that, the people who are watching are interested in, please do submit those to Gary. We want to talk about what you want to hear about, not necessarily what we want to talk about. A lot of times those are congruent, but let us know.
All right. And Jennifer, I got your email. Thank you. I'm forwarding it right now to Jack. So we'll see you guys next week. Be safe out there. Have a great rest of the week and weekend that's coming up.
Thank you.
Take care.